Hello, Professor Liu. This is our group's video in Group Project 2. Today, our group will talk about a practical topic, why a company's stock price sometimes rise or fall sharply. Our group will take Netflix as an example. Uh, First, let's look at its three key events. The first event is happened on April 2022. On that day, Netflix lost paid subscribers for the first time, about 200,000. And what worried investors more was that Netflix also said we will lose even more subscribers in the next quarter. The stock reaction is the stock price dropped by 35% in one day. So from a valuation perspective, we think two things happened which pushed the stock price down. First, its long-term growth slowed down. Fewer new subscribers, less time users spend on the platform, and even trouble raising prices all meant Netflix would make less growth in the future. Secondly, investors felt more risk. Back then, the video streaming industry was more competitive. Everyone thought Netflix could charge for password sharing, but it turned out to be harder than they expected. So the investors started asking for higher returns. So the WACC went up. If G gets smaller and WACC gets bigger, the denominator grows from both sides, so that pushes the stock price down fast. We think the lesson in the event A is clear. For platforms that make money from subscriptions, like video apps or membership, the story of steady growth is everything. Once investors stop believing that story, the stock price changes right away.
Event B, October 18, 2022, growth resumes. Advertisement tiers and paid sharing after hours plus about 14%. 6 months later, the story pivoted. On October 18th, 2022, Netflix returns to positive net adds, about 2.41 million, and guided to 4.5 million for the next quarter. Management also laid out two monetization levels, and ad-supported planning and paid sharing enforcement. So evidence there is double positive shock. First, G raises higher ARPU potential from advertising, better conversion from price-sensitive user, and a clearer path to scale lift the trajectory of future FCF. Second, the risk premium eases. Investors grow more confident the business model can balance growth and monetization, nudging WACC lower. Put differently, the numerator, except cash flows, look bigger, while the denominator, WACC minus G, looks smaller. That combination produces an offset price response, which we saw as an approximately 14% after-hours bounce. The takeaway: credible growth plus monetization resets the narrative and can reflect the multiple quickly. Then comes to the event C, April 18 to 19, 2024. Stop quarterly self-disclosure from 2025, shares for 9%. In April 2024, alongside solid results, Netflix announced it would stop reporting quarterly subscriber numbers starting in 2025. Even with good fundamentals, the stock fell, and the valuation logic explains why. Markets don't just price cash flow, they price confidence in this cash flow, reducing a headline operating metric lower transparency, widens the forecast dispersion, and raise information risk. Investors respond by requiring a higher expected return. our WACC tick up. Some also infer a mix shift from user growth toward margin that can trim G if the market believes the growth signal is weaker. In the DCF frame, a higher WACC and a possibly lower G means a higher WACC minus G, which compresses valuation even if near-term profits look fine. So for the lesson, disclosure policy is part of risk management. Less frequent metrics can reduce noise, but they also raise the discount rate if investors feel visibility has deteriorated.
Hello, Professor Liu. I will use some multiples of a few comparable companies to determine ranges of the firm value. I'll use the capital IQ to make a quick cops. The first and foremost thing is to find some comparable companies. The industry of Netflix is movies and entertainment. There are many famous peer companies such as Warner Bros., the Walt Disney, Paramount, and Amazon. It is worth mentioning that the EV revenue multiple of Netflix is even higher than the maximum multiple of comparable companies, which means that people have strong confidence that the future revenue growth potential of Netflix. Here is the valuation of Netflix. The maximum is $2,400 per share, and the minimum is $284 per share, while the average is $910 per share. The real stock price of Netflix is $1,153 per share, which is within the range of valuation, but lower than the average. Then I'll try to explain the difference in valuation across comparable companies. Please look at the green column, which is the yearly growth rate of sales. We can see that the growth rate of Netflix is 14.84%, while only second to Roku. However, the EBITDA margin, the EBIT margin, and net income margin is second to none. These statistics show that Netflix is able to achieve a higher growth rate while maintaining a lower cost of operating comparing to its peer. So no wonder that average comparable company's valuation is lower than the real stock price because Netflix actually outperforms most of the peer companies. The operating method helps Netflix achieve success. Netflix focuses on streaming media only, avoiding the complex cost structure of multiple business lines such as parks, licensing, and sports content for companies like Disney. In contrast, Disney needs to invest heavily in fixed costs for sports content and amusement park business.
Hi, Professor. This is Yishen. On this part, we'll introduce beta and how we calculate it. To measure the equity risk, we use beta, which is a measure of the stock's volatility relative to the market. It indicates the sensitivity of the stock's returns to overall market returns. If beta is greater than 1, the stock is more volatile than the market, and this chart plots Netflix excess returns against the market's excess returns. Each dot is one observation. The blue line is the best fit regression. And for Netflix, our estimate is beta equals to 1.42. Intuitively, when the market return changes by 1%, Netflix tends to move by about 1.42% on average. Also, the positive slope and tight cloud around the line show a clear positive sensitivity to market moves. And on this page, we track the historical data for Netflix, the market, and the peer average from January 2022 to July 2025. The blue line is Netflix beta. It starts very elevated in early 2022, briefly above 2, and showing much higher sensitivity to market moves. Through 2023, it trends downward and stabilizes mostly between about 1.1 and 1.4. The gray line is the peer average beta. It follows a similar pattern but stays consistently lower than Netflix, which means Netflix has carried higher systematic risk than its industry peers for most of the period. SPY's beta is 1 because SPY is our market proxy. And through this chart, we can figure out that although Netflix risk exposure
has declined and stabilized versus 2022, but it remains above peers and the market, which supports a higher required return on equity when we apply campaign. Next, this slide shows the cost of equity for Netflix. So we apply campaign, which is used to calculate the cost of equity, and the equation is shown on the slide. It reflects the return that investors expect to receive for taking on the risks of investing in a particular stock. And here in the Netflix case, we use the 10-year Treasury yield as the risk-free rate, which is 4.80%, and beta, as calculated before, is 1.42. And we estimated the market risk premium to be 5%. So after calculation, cost of equity equals to 11.28%, which is the return investors require for holding Netflix equity given its market risk. So for part 5, this line summarizes default risk and our cost of debt for Netflix. Default risk is the likelihood a company fails to meet its debt obligations. For Netflix, we reference its 6.775% senior unsecured bond maturing at May 15, 2029. Because it is a senior unsecured, the debt is not backed by specific assets, so investors demand a risk premium for potential default. And another key terms, USD issue $800 million outstanding, and minimum settlement $2,000 is shown on the table on the left side. To estimate the cost of debt, we use the bond's year to maturity, the annual return investors require to hold the bond. So for this issue, we take the YTM of 6.375% as Netflix cost of debt.
Hello, Professor. Now we are going to talk about the last part, or overall cost of capital. So using a 10-year Treasury yield of 4.18% in late September 2025 as our risk-free rate, a market risk premium of 5%, and historical beta equal to 1.42. The current cost of equity is 11.28%. We also measure default risk from market bond yields. Netflix market yield to maturity is taken as RD to be 6.375% as the cost of debts. With total debts of $288 billion and market equity of 5,253 billion. The capital weights are about 94.8% and 5.2% accordingly. Ignoring the tax give us the weights average cost of capital of 11.03%.